Hi everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account and today's market update. Right now, the net asset of my account is $70,026.26. Today, Apple has closed up 0.05%, and SQQ closed down 0.53%. SPY closed up 0.18, and United Natural Gas closed up 0.41. Today, the industries generally performed slightly above average. Dow Jones Industrial Average closed up 0.3%, Nasdaq closed up 0.16%, and S&P 500 closed up 0.14%. Today, the biotech and auto manufacturers led with a gain of more than 1%. On the other hand, internet content and software closed down with less than 0.5% loss. And according to Goldman Sachs prediction that the difficult part of the interest rate hike cycle is over and the economy and the investment environment are going back to before the 2008 level. They expect a 15% chance of a recession and expect some positive factors to support global growth as investment as the macroeconomy recovers to pre-2008 levels. Jesus, one of the Goldman Sachs strategists, said 2024 should consolidate the idea of global economy that has escaped the post-pandemic financial crisis and the return of low inflation, zero policy interest rates, and negative real yields in the past decade. The period since the global financial crisis, it has often been an inevitable trend of falling global yield and falling inflation. Policymakers have entered the era of easy money, and the transition to high interest rates so far have been rocky, as illustrated by the volatile stock market, rapid tightening of financial conditions, and growing collapse of zombie businesses. The big question is whether a return to the interest rate context before the global financial crisis is in equilibrium. The strategist said, the US answer is more likely to be yes than elsewhere, especially in Europe, where sovereign pressures and inflation pressures are more likely to be resistant. The Fed cut interest rates to near zero after the financial crisis, but a return to a high-rate environment could cause trouble for the high-indebted businesses and broader business climate. Other Wall Street forecasters have also warned of a wave of bad debt as distressed balance sheets in the coming months as financial conditions tighten. Charles Schwab estimates that the default will peak between now and the first quarter of 2024. And the favorable factors are that the interest rates, credit stocks, and commodities would surpass cash by 2024. The transition has been bumpy, but the benefit will be that the environment will overall be more beneficial towards investors rather than cash keepers. The great escape is the investment environment now looks more normal than any time before the global financial crisis, and the actual expected return certainly looks positive now. He refers to the transition from easy money era. Goldman Sachs believes that by 2024, inflation should continue to fall. Real household income should rise, manufacturing activity should rebound, and central banks led by the Fed should be increasing willing to cut interest rates. By then, the global economy will fully be recovered from the pandemic and the impact of the pandemic. Despite their relative optimism, strategists say that they see risk in 2024 as above normal levels. Even if inflation continues to be stable, the Fed and other central banks are likely to keep interest rates higher for longer than expected. There are also downside risks to economic growth, the bank said. The recovery in the global manufacturing could be delayed, especially if high interest rates prompt companies to normalize inventory levels relative to sales levels below 2019 levels. This is all I have for today. Thank you for listening. I hope you enjoyed the forecast for next year's economy, and see you next episode.